Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. When we have a question about commodities, we always go to Daniel Hynes, Senior Commodities Strategist at ANZ. Oil prices are up around 40% this year after hitting record lows during the pandemic. Gold is high as well, though still south of the $2,000 an ounce milestone it passed when global markets were at their most uncertain last year. Thermal coal prices have surged, and Australia is continuing to benefit from very high iron ore prices. And just last month, copper prices, considered a barometer of economic growth, hit a decade high. It's a busy time if you're a commodity strategist. Daniel, are you busy?
Absolutely, but they say there's never a dull moment in commodity markets, so I'm pretty used to it these days.
Fair enough. Now, there's so much happening. What is your pick in terms of the most exciting story? Which is the commodity that you're looking at and thinking, wow, that's amazing, that's happening?
Well, you talk about copper being the barometer of the economy, and that's more so the case now than ever before, really. It's not just the economic rebound we're seeing from the pandemic, and we can track what that means for copper in particular, but it's really this energy transition, this new economy which is now emerging, which makes the story even more exciting. How copper, its properties around, the movement of electricity is going to be absolutely critical in the decarbonisation of the world economy and the electrification which will come with that. So, it's a market which I'm following pretty closely.
So is that why copper, I've often wondered why copper is such a barometer and whether it will still be going forward, but because of its properties and its ability to transmit electricity, is that kind of why it will always remain in demand, and in fact growingly so, with the decarbonisation of the world?
Yeah, I think so. I mean, it has a very broad consumption sort of pattern, so it touches most parts of the world economy. And that's why we always talk about it as being a pretty close and good barometer of how economic activity is going. But yeah, I think it's definitely at the core of this energy transition. And look, there's a lot of other metals which can also transmit electricity, obviously at a much lower sort of rate. So you always worry about ultimately, prices and how that affects the cost of, using more material of other metals, which may not do it as efficiently. But yeah, I think copper's properties there really place it at the forefront of what the world economy is sort of moving towards at the moment.
Okay, so let's go to oil. That's up about 40% this year. Why is that so strong?
Yeah, when you see such a hit to demand, and prices did collapse, and as many of your listeners would probably remember, we actually saw negative oil prices for a period early in the pandemic. But as economies are starting to reopen, we're seeing people move. There's not only a rebound in purely that sort of level of activity, there's pent-up demand building now as well. And certainly domestically in a lot of economies, with international borders still closed, so obviously jet fuel or fuel for air travel is subsequently weak. We're seeing a huge amount of pent-up demand for domestic travel, both in terms of air travel, but more so the vehicles, so gasoline and diesel or petrol. So that huge pent-up demand is really driving growth in crude oil globally. And at the same time, we're having the good old supply side issues really impacting the market there. OPEC continuing to constrain output, and interestingly, we're finding that overall oil producers are fairly reluctant now to invest in additional new capacity due to this decarbonisation, this climate change environment we're finding ourselves in. They're putting more money into renewable energy capacity as a consequence, and that's going to keep the growth in supply relatively low in the shorter term.
So that could well put a bottom on prices because banks don't want to lend to fossil fuel industries. And while we transition, because we've still got decades, we will still need oil and gas for decades, I'm guessing. But if it's harder for new facilities to come online and banks don't want to lend for it and that, does that mean that potentially a paradigm shift in terms of the base rate lifts somewhat in the next few years?
Absolutely. And you can point to, the thermal coal market in particular to see how that is playing out. That is clearly going to be the first market which comes under pressure as these new climate change policies force the move towards renewables. And certainly demand has been weak, particularly in some of the developed markets like the Europe and the US. But there has been very little investment in new capacity in that market for quite some time. I mean, prices have been on the decline, over a long period. But, we haven't really seen new major mine in Australia really come onto the market. So, when you look at these commodities, some of them will be impacted, certainly in the fossil fuel sector, by declining demand. But you also got to look at how supply is tracking as well. And, if you do see that fall, obviously even more so than demand is, then you could still have a tight market and relatively good prices.
Yeah, I mean, you mentioned thermal coal. Last week there were reports about China, India and Vietnam, particularly demand from those economies picking up, which really pushed thermal coal prices through the roof.
Yeah, I mean, thermal coal is back up around $120 a tonne. That's the Newcastle free on board price. So that's pretty high compared to where we saw it last year. And, when you're getting a rebound in economic activity in general, you tend to see all the energy markets respond as a consequence. So thermal coal's being dragged up by the general increased level in, electricity generation. And look, Asia is still a fairly strong, big user of thermal coal for its electricity generation. So we're seeing that really play out. But there's been other factors. I mean, we had a very cold northern hemisphere winter, which really boosted demand for all the energy fuels. And now we're starting to see forecasts of a much warmer northern hemisphere summer as well. So that's certainly driving a lot of utilities to restock in their gas and thermal coal inventories to really buffer them from that at a time when economic activity is rebounding as well as some of those restrictions start to ease across the region.
Okay, so what's your outlook for gold?
Yeah, well, gold is in a bit of a sweet spot at the moment, and it's sort of gone a bit unnoticed, really. We saw prices rally into the end of last year, nearly threatening to sort of break through $2,000 an ounce. But as that risk appetite in markets increased, and we saw some fairly strong growth numbers come through, gold was battered lower. In fact, fell to about 1,700. But since then, from sort of late March, we've seen it steadily increase. And it's been those inflation expectations which have really been driving prices higher. Now, people may have heard this before, but gold has always been seen as a sort of a hedge against inflation. And so we find when periods of high inflation are around, we get a strong level of investor demand come through. And we saw a fairly strong number come out of the US last month, around just over 4%, I think it was, and that did sort of spark a bit of buying in the sector. And at the same time, the Fed has continued to ease concerns about those types of spikes happening for a sustained period of time. They think they'll remain fairly transitory and short-lived. So there is sort of a window, we think now, where with a weaker US dollar, as that economic activity broadens across the globe, we see rising inflation and subsequently lower bond yields, then gold has got a very conducive sort of backdrop to continued inflows from the investor sector. So look, we think it can push back above $2,000 an ounce, which it hit at the peak of the pandemic last year.
Stay with me, Daniel. We'll be back in a minute. My guest this morning is Daniel Hynes, Senior Commodities Strategist at ANZ. Okay, so the big one for Australia, of course, those iron ore, and Elizabeth Gaines, who's the boss of Fortescue Metals, last week said she was confident that the industry would continue to thrive, notwithstanding recent comments out of China, and also the revival of Vale out of Brazil probably wouldn't hurt Fortescue, she said. And she wasn't even that worried about China going into West Africa and developing mines there either. Clearly, there's still a lot of demand for iron ore.
Absolutely. It's been phenomenal, to be honest. I think the Chinese market, the economy there has certainly sort of reverted back to some of their old ways in terms of growing the economy there with investment-led spending in infrastructure in particular, really driving growth for steel and iron ore as a consequence. And you can't dismiss, I suppose, the impact that these new climate change policies and the like really will have on demand. Certainly infrastructure for renewable energy systems is really starting to make a difference now, rather than being a bit of a single line in our models. So, the demand backdrop is certainly very conducive in China, but even more also broadly in some of the developed markets. But I do worry, I suppose, a little bit about supply. In some of those markets we're just previously talking about, there is a lack of investment really in new capacity. But iron ore is one where we haven't really seen that. Margins are exceptional. I mean, BHP and Rio produce at around $20 a tonne, and they're selling it for $200 at the moment. So pretty good margins.
Yeah, that's not bad.
And that's certainly going to introduce some additional supply. But, it's Vale who is still recovering from both the dam disaster a couple of years ago and obviously the impact of the pandemic last year. And it does look like they'll finally be able to really boost supply later this year and into 2022, which will clearly weigh on the market in the short to medium term. So we're a little less positive on that side of things, but I still think prices will hold up relatively well, and those prices will be at relatively good levels.
Just before I let you go, Daniel, Robin Denholm, the chair of Tesla last week, was speaking, and she, I think it was about $1 billion annually out of Australia, she thought would be spent buying things like lithium and rare earths and minerals. They're interesting, those commodities, because we know less about them, but they're obviously commodities of the future.
Yeah, and I think the developed economies have to be quite careful that they secure enough supply really to really drive some of these sectors. I mean, China obviously dominates in some of the rare earths in particular, and there's some concern about them really controlling that supply for their own purposes. So, the US and Europe will need to encourage, I suppose, investment in some of those sectors to supply what could be potentially very strong levels of growth. So Australia is really key there, very a large producer of lithium in particular, and other sort of more esoteric metals which go into some of these new technologies that we're seeing come through at the moment. So it'll be very important for us to focus on the development of those industries to meet the needs that we see occurring over the next decade or two.
Daniel, when you were a kid at high school, did you actually know the periodic table or not?
I did, yes. I had a periodic table on my wall amongst all the football posters and things like that.
Right. I was wondering, you become a commodity strategist if you like periodic tables in football, probably.
Yeah, probably. They are a good mix. I do enjoy them. I mean, I was obviously a bit more about blowing things up, to be honest, being a mining engineer in my days, but it is a fascinating topic.
Yeah. Daniel, thanks for talking to Fear and Greed.
My pleasure, Sean.
That was Daniel Hynes, Senior Commodities Strategist at ANZ. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.